Let's talk about OpenDoor, because this stock just went absolutely wild. OpenDoor shares just exploded, rocketing up an insane 200% in just 1 week. We're talking about a company that was pretty much left for dead, trading for less than $1 a share, almost kicked off the big stock exchanges. Now, it's a full-blown meme stock, with some folks calling it the next GameStop. You're probably wondering how a company struggling this much could do that. I'll explain the wild forces at play and what this means for your money later in the video. We're also going to look at the massive risks involved, and I'll give you the full scoop on whether this is a real comeback story or just a pump and dump at the very end. So stick around. First, what in the world caused this massive surge? It all started with one guy, a hedge fund manager named Eric Jackson. He's the head of a firm called EMJ Capital, and he hopped on social media, specifically X, and dropped a bombshell. He said his firm bought OpenDoor shares because he believes this company could literally multiply its value by 100 times in a few years, aiming for an $82 price per share. Now, why did people listen to him? Because he's got a track record. This is the same guy who was super bullish on Carvana when that used car seller was trading for just a few bucks a share. Everyone else thought Carvana was toast, but then Carvana made an epic comeback, shooting from a few dollars all the way back up to over $350. That's like going from zero to hero, a true record breaker in the stock market. Because he pulled that off, people are paying attention to what he says about OpenDoor. Jackson's social media following has exploded. He's talking about OpenDoor being the next 100-bagger. And there's a real hunger out there. People, especially retail traders, are done with the big famous tech stocks. They're looking for the next big score, the next underdog story, the next left-for-dead company that nobody believes in. And that brings us to the second massive force fueling this fire, the meme stock machine. You remember GameStop, right, or AMC? OpenDoor is quickly becoming the next one. These are companies where the stock price goes totally insane, not because the business is suddenly great, but because of a massive surge of buying from individual investors, often coordinating on places like Reddit's Wall Street Bets forum. Here's how it works. OpenDoor had a lot of people betting against it. About a quarter of the company's shares were being bet against. That's called short interest. When a stock with high short interest starts going up, those who bet against it are forced to buy shares to cover their bets, to stop losing even more money. This creates a massive buying frenzy, pushing the price even higher in what's called a short squeeze. It's like lighting a fuse on a powder keg of anticipation. The numbers are staggering. On Friday alone, over 300 million shares changed hands. That's more than 3 times the normal trading volume. In just 4 days this past week, more call options, which are essentially bets that the stock will go higher, were traded than in the entire 6 months before that. The excitement is so big that OpenDoor is now trading more volume than giant companies like ExxonMobil and Oracle before the market even opens. This isn't about the company's sales. It's a massive trader-driven momentum play. But here's the cold, hard reality check. The business itself is still in deep trouble. OpenDoor is an online real estate company that buys homes directly from sellers for cash, then makes small repairs and tries to flip them for a profit. It's called iBuying. Sounds cool, right? Well, it hasn't worked out so well. They went public in 2020 and the stock soared to almost $40 a share, but then it crashed, falling all the way down to just 50 cents. Why? Because it's a capital-intensive business, meaning it needs a ton of cash to operate. And when interest rates shot up and the housing market slowed down, OpenDoor started bleeding money. They laid off a ton of workers, and they were even threatened with being kicked off the NASDAQ because their price was so low. They also had to pay out $39 million to settle a lawsuit from investors who said their pricing tech couldn't keep up with the market. OpenDoor has been losing money, hundreds of millions of dollars year after year. They only sell about 3,000 homes a year, which isn't much for a national player. Most financial analysts still have a hold rating on the stock, or even a sell. They think the stock should be trading at about 80 cents a share. That's a massive drop from where it is now. Some even point to a financial red flag indicating serious bankruptcy risk. They're buried under mountains of debt. However, OpenDoor has been trying to pivot. They're moving away from just buying homes themselves and are trying to partner more with real estate agents. And crucially, their old rivals like Zillow and Redfin have actually pulled out of the iBuying business, leaving OpenDoor with less competition. So there's a small glimmer of hope there. So what happens next? Is this surge just a flash in the pan, or is there a real chance for OpenDoor to change its fortunes? Here are the potential catalysts that could keep this wild ride going. 1. More big investors. Eric Jackson is hoping other large investors, maybe even Chamath Palihapitiya, who helped take them public, will join in and create a snowball effect. 2. Earnings report. The company is scheduled to report its latest earnings in early August. Jackson is predicting this could be their very first quarter where they actually make an operating profit in 3 years. If they deliver that and show a path to continued profits, that would be a huge deal, a real game changer. 3. Reverse stock split cancellation. OpenDoor had a plan to do a reverse stock split, which is basically combining shares to artificially boost the price. It's often a sign of desperation. If the stock stays high, they might cancel this plan, which would be seen as a positive sign. But don't forget the major risks that could send the stock crashing back down. 1. Management woes. There are concerns about the current CEO, with one of the company's co-founders expressing negativity. You need a top-notch team to pull off a turnaround like Carvana did. 2. Cheap sell-off. If OpenDoor can't turn things around, it might get sold to another company, but probably for a measly $3 or $4 a share, nowhere near Jackson's $82 target. 3. Shaky fundamentals. The business still needs help from the housing market. Right now, traders are ignoring the fundamentals, but they won't forever. If the business doesn't improve, this rally will run out of steam. Some big money traders are already betting that a crash is coming next. This whole situation is like a high-stakes poker game. Eric Jackson laid down his cards and showed a strong hand, his Carvana track record, and a bold prediction. The retail traders saw it and went all in, creating this massive surge. But the company itself, OpenDoor, is still holding a few uncertain cards, like its upcoming earnings and whether it can truly fix its business model. The question is, who will walk away with the pot? This is a high-risk, high-reward play. While the hype is real and the short squeeze is powerful, the business itself still has huge hurdles. It's not for the faint of heart. If you found this breakdown helpful, make sure to like this video, subscribe to the channel, and hit that bell icon so you don't miss our next market update. Thanks for watching.